Stock staying strong into the last 10 minutes. Nate Peterson's with us for our big picture discussion. He's the director of derivatives analysis at Schwab Center for Financial Research. Heck of a 2 days recovering yesterday's losses. Nate, what do you think?
It certainly is. Your previous guest was talking about the volatility. I mean, this week has just been, potent with catalysts, whether it's the FOMC, mega cap tech. We got non-farms tomorrow. Even today, with yields hitting on the 10-year, hitting a year-to-date low. I'm guessing that's related to the regional bank issues. I'm not precisely sure there because, given the markets, how stocks reacted yesterday, I don't think yields are down because they think the Fed is dovish or it's going to be more aggressive with its rate cuts. But here we are, year-to-date lows. Obviously, stocks are taking their cue from that, using the 10-year as a proxy. We'll see what happens with mega cap tech. But Oliver, after we get past these reports tonight, I mean, February is the worst month for the NASDAQ. So keep that in mind. This feels a little bit like July of last year. After mega cap tech reported, we basically sold off all the way into October. I'm not suggesting that's going to happen again, but for our tech traders out there, I think you should expect or maybe expect some volatility, and at least if you respect and believe in the seasonality, the potential for some kind of like a 3 to 5% pullback, that would be par for the course if we got that in February this year.
So January right now, obviously we ended it pretty good. I like the parallels to where we were a couple of years back. The calendar year turned over, January earnings started to hit. That was kind of the beginning of that bear market. What type of level of disappointment do you think we need here? The market's obsession with keeping March at 40%. I mean, does that put a little bit of a net under how far these stocks can drop if they don't do everything perfect today?
Well, yields are showing that they can still go down regardless of what the Fed says.
Right.
So if yields go down, I think that would be good. Look, and if those that were looking for 6 or 5 or whatever the case may be this year, there's continual resetting of these expectations. It's always, the Fed's going to be our friend. They're going to be accommodative. They're going to cut. They're going to be dovish. And then the Fed comes out and basically says, not so fast. You're not the tail wagging the dog here. And then they push out their expectations, but as evidenced by the probability. So if that continues to happen, not a big deal. I think if we get a couple of rate cuts this year, that's great, provided the economy hangs in there, provided inflation does not kind of creep back up. We saw prices paid on ISM come in at a 9-month high. And I think, yeah, this might be a tail risk, because it doesn't seem very likely given, the inflationary data has been good. But what if you look at all the evidence of the economic strength, be it retail sales, be it GDP, be it ISM, S&P Global Composite numbers that came in last week, durable goods, et cetera. If we start to see inflation creep back up here, imagine what if the Fed had to actually go back out and change their stance and say, hey, we might be looking to hike again. That would throw a monkey wrench in the bulls' thesis.
The fact that we rallied bonds also through that good PMI and ISM today, to your point, even with prices paid high and a big pop in durable or new orders rather for PMI services. I guess there's an idea tomorrow might go poorly for jobs. Looking at the S&Ps right now, I know you're a technical guy, you're a level guy, and how it connects to the VIX. VIX also backs down a tiny bit, but vol has been creeping for a couple months here.
It has started to creep up a little bit. We're at 14 on the VIX. A 16 is a 1% move. We dropped 1% yesterday or more. We're up more than 1% right now. This is a 30-day estimate. So, Oliver, I don't see anything too unusual in the VIX. I think perhaps because of seasonality, you can sometimes see an uptick. I think, February and March, those months have not been, strangers to getting some kind of volatility within the market. It doesn't mean that history has to repeat here, but perhaps that's related to a little bit of uptick in the VIX. And regarding non-farm payrolls, I was mentioning to Tom and Kevin on Fast Market, if we start to see these numbers come in a little bit soft, when we see the initial claims that have been above estimates, for the past couple of weeks, although they're still historically low. If we start to see these non-farm payrolls come in soft and then the unemployment rate kind of creep up towards 4%, I think no problem there. provided the economy hangs in there, because we're going to assume that that's going to translate into corporate earnings. We saw some of the estimates for GDP that are looking pretty robust from the Atlanta Fed, though that is the Atlanta Fed and it's due to revision and it's subject to revisions. But I just think as long as the economy hangs in there, as long as the earnings story continues to, for the most part, deliver. And by the way, tech, for the most part, is doing pretty good. If you look at the results anecdotally out of like a super microcomputer, and what that translates into NVIDIA, which we'll get on the 21st, this AI story is being validated by a lot of these earnings reports there. Microsoft, 30% versus 27.5% on Azure. That's great. Right. So that's good news for the bulls.
For sure. All right. Good stuff. Thanks for the thoughts, Nate. Appreciate the big picture discussion and reminder of this morning's data as well.